A telecom stock down 48% in a year, trading at just 56 cents per dollar of sales, with analysts screaming strong buy and a $4 price target. That's a 74% upside. But here's the catch. Its profit margin is barely hanging at 0.38%. So what's really going on with Ceragon Networks? Ceragon Networks is a player in the wireless telecom infrastructure space. They build wireless backhaul solutions, basically the invisible networks that connect cell towers to the internet. Think of them as the plumbing behind 5G and mobile networks. They're customers, telecom operators around the world who need reliable, high-speed connectivity. With the global push for 5G expansion, Ceragon sits right in the middle of this infrastructure boom. But the question is the stock a hidden gem or a value trap? Let's talk numbers. Ceragon has a tiny market cap of just $206 million. That's small cap territory. The stock has been hammered, dropping nearly 48% over the last year. Right now, it's trading at $2.30 per share. But here's where things get interesting. 3 analysts covering the stock have given it a strong buy rating with an average price target of $4. That's a potential 74% upside from current levels. Earnings are due on February 9th, 2026, just days away. So all eyes are on what management will say next. Let's break down the financials, starting with revenue. Ceragon pulled in $363 million over the last 12 months. That's solid for a company of this size. Gross margin sits at 33.89%, which is decent for a hardware-focused business. Now, here's the reality check. Net income, just $1.39 million. Yes, you heard that right. On $363 million in revenue, they barely made a profit. That translates to a profit margin of only 0.38%. Earnings per share, 2 cents. That's why the trailing PE ratio is sky high at 147, because profits are razor thin. But the forward PE ratio tells a different story. It's sitting at 18.78, which suggests analysts expect a major improvement in earnings this year. So the market is pricing in a turnaround. Let's talk about cash flow, because this is where things look more promising. Operating cash flow came in at $21.66 million, and after capital expenditures of $14.30 million, free cash flow was $7.36 million. That's positive, and it shows the business is generating cash even if net income is tight. On the balance sheet, Ceragon had $42.9 million in cash and $47.61 million in debt. So they're carrying a small net debt position of $4.63 million. The debt-to-equity ratio is just 0.28, meaning the company isn't over-leveraged. Interest coverage is strong at 35.89 times, so they're not struggling to service their debt. The current ratio is 1.81, which means they have enough short-term assets to cover liabilities. Overall, the financial position isn't alarming. Here's where the stock gets interesting. The price-to-sales ratio is just 0.56, meaning you're paying 56 cents for every dollar of revenue. That's dirt cheap compared to most tech and telecom stocks. The EV to EBITDA ratio is 6.26, which is quite low for a growth-oriented infrastructure company. But remember, low valuation doesn't always mean a bargain. Sometimes stocks are cheap because the market sees limited growth or execution risk. Return on equity is just 0.84%, and return on assets is 3.91%. These are low numbers, showing the company isn't generating strong returns for shareholders right now. Strengths, what's working? So what does Ceragon have going for it? First, positive free cash flow. Despite thin profit margins, they're still generating cash, which is critical for reinvestment and survival. Second, low debt. With a debt-to-equity ratio of 0.28, they're not buried in leverage, which gives them flexibility. Third, analyst optimism. A strong buy consensus with a 74% upside target suggests Wall Street sees something the market is missing, possibly contract wins, margin expansion, or improved guidance. And finally, 5G tailwinds. The global rollout of 5G networks is a long-term growth driver, and Ceragon is positioned to benefit as telecom operators upgrade infrastructure. Risks. What could go wrong? Now let's talk risks, because they're real. First, profitability is a major concern. A 0.38% profit margin is razor thin. Any unexpected cost increase or revenue miss could push the company into losses. Second, execution risk. The forward PE of 18.78 assumes a massive improvement in earnings. If Ceragon misses estimates or guidance disappoints on February 9th, the stock could drop further. Third, competition. The wireless backhaul space is competitive with bigger players like Ericsson and Nokia. Ceragon needs to keep winning contracts and defending margins. Fourth, the Altman Z-score is 1.59, which signals potential financial distress. A score under 3 suggests increased bankruptcy risk, though this doesn't mean it's imminent, just something to watch. And finally, the stock has been weak. Down 48% in a year, sentiment is negative, and it could take time for investor confidence to return. Ceragon Networks is a high-risk, high-reward play. If the company can improve profitability and deliver on analyst expectations, there's significant upside. The low valuation and positive cash flow are encouraging signs. But the weak profit margins, execution risk, and financial distress score mean this isn't a safe buy-and-hold stock. It's a speculative bet on a turnaround. Earnings on February 9th will be critical. If management delivers strong guidance and shows margin improvement, the stock could rally. If not, it could continue drifting lower. This isn't a stock for conservative investors. If you're comfortable with volatility and believe in a turnaround story, it might be worth watching closely, especially after earnings next week. As always, this is not financial advice. Do your own research, consider your risk tolerance, and invest accordingly.